Good evening, students. Welcome to the live coaching classes organized by Board of Studies ICAI. This evening is the last session for your indirect taxes under paper 8. We're going to study on this topic called foreign trade policy. The very less discussed topic, the very less experienced, rather untouched portion in the entire 3 years of your internship is on this topic called foreign trade policy. So we have two aspects over here: basic introduction to foreign trade policy. From there, to understand the overview of various modules under this handbook of procedures under foreign trade policy. So what I have done today, I have collated all this data, practical relevant aspects in my today's discussion. And before we start, students, let me have a confirmation from you. Please confirm whether the audio is available, video is available, and the presentation is also visible. Once I have a confirmation from some of you, we'll go ahead with our today's discussion. Thanks for the confirmation, Priya. Great. So let's start with our today's discussion on this topic called foreign trade policy. And I'll put it this way. Examination point of view, you'll have one MCQ and one theory question for 4 marks in terms of examination, evaluation of advance authorization or RODTEP. Refund of duties and taxes by export of goods exported from India. EPCG, eligibility for claiming export promotion capital goods. So you have DFIA. These 4 to 5 schemes which are tested for examination 5 marks. So barring these 4 to 5 exemptions which are there under foreign trade policy, read with few MCQs, not much to worry from your examination point of view. And what is there in your syllabus, like similar to your customs law, very nominal portion is there, considering the depth of the coverage which is required for one to understand, right? So today's session, we will have an overview of Foreign Trade Development and Regulation Act 1992. 1990 is the golden era where we had this particular globalization, where we have seen a plethora of opportunities opened up for the Indian traders. That point in time, the government of India have come with this particular Foreign Trade Development and Regulation Act. And most of these aspects which we discuss in foreign trade policy are in line with the World Trade Organization practices. The duty exemption schemes, incentives provided to the traders, and the norms thereof. All those aspects are the global practices, right? So this particular foreign trade regulation, we call FTDR. This particular foreign trade regulation was given in order to facilitate the imports and exports which are made out of India. So this particular regulation has given further aspect called foreign trade policy, which is governed by this entity called DGFT, Directorate of General Foreign Trade. Ministry of Commerce, we have Ministry of Revenue who regulates the GST law, the customs law. Similarly, we have Ministry of Commerce who regulate this particular foreign trade policy. Now, if we have to understand, so what is the need for a foreign trade policy? What happens if we don't have this particular foreign trade policy? We have something called customs law. Now, when I have customs law, why is that we need to understand foreign trade policy? Now, keep in mind, this foreign trade policy is just to give a guidance how my export-import aspects needs to be done. So any goods which are exported out of India, any goods which are imported into India, these particular goods needs to be regulated. So the goods which are freely tradable, the goods which are restricted, the goods which are prohibited. The policy matter, the decision is always with this Ministry of Commerce, who give a guidance, they frame a policy. So this Ministry of Commerce and Industry regulates my foreign trade policy. So this is basics for this particular foreign trade development and regulation right with your foreign trade policy. Now, there are a few aspects called salient features, means what we need to understand, what is the importance from my foreign trade policy. So here they say, look, all the goods and services which have to be exported or which have to be imported, let it be free. So when I say free, it doesn't talk about your duties and taxes. This is a decision, this is a policy where they would like to say, should we give a free hand, should we restrict, or should we prohibit? So they have categorized your exports, they have categorized your imports into these three aspects. Sorry, precisely this is given for imports. So I have my category of imports, which is free, which is restricted, which is prohibited. Now, when we read this foreign trade policy, students, most of these principles of foreign trade policy are in line with my customs law. Or I would say this way, the decision is made by foreign trade policy. The policy is formulated by foreign trade policy. This will be adopted for implementation by way of issuing an exemption notification, by way of issuing a notification for regulation under customs law, under GST laws, under central excise law. So what happens here? My Ministry of Commerce and Industry, my Ministry of Commerce and Industry will frame a policy. This policy is adopted or this is implemented by Ministry of Finance. Now, Ministry of Finance cannot question Ministry of Commerce and Industry. Why have you given this particular policy? Why you have given exemption, free hand for a few set of goods? Now, once a policy has been decided by this Ministry of Commerce and Industry, Ministry of Finance has to synchronize their provisions in tune with Ministry of Commerce. So for that reason, you would see this customs law. If you recollect this exemptions chapter, what we have read, my exemptions chapter talks about levy of a customs duty. In addition to that, they talk about additional duty. Policy was made to regulate how much worth steel can be imported into India. A policy decided by Ministry of Commerce. Based on this policy, the notifications are issued under my Ministry of Finance, which are seen under customs law. So if you look overall, the Customs Act, what we see as on today, the exemption notifications, tariff notifications, procedures which are there under customs, these are issued under Ministry of Finance. However, my Ministry of Finance has a tandem, has a synchronization with this particular Ministry of Commerce. So when I say goods can be imported free, goods can be exported free, there is something called state trade enterprise. Means some of the organizations, some of the entities, some of the goods which are monitored by state trade enterprises. Right? Now, the Ministry of Commerce exports the trade, that is export related activity. Now, foreign exchange has to happen. How can I have a foreign exchange? Only when I make a export of goods, export of services. So this particular Ministry of Commerce comes with something called promotional schemes. What do you understand by promotional scheme? Where the Ministry of Commerce, that is your DGFT, says, look, I'll give you something called duty credit script. Students, all this, what I'm talking to you, is all basic fundamentals which is governed by way of a foreign trade policy. So these aspects are covered under salient features. Examination, What are the salient features of foreign trade policy? Where you will say that regulation of import and exports, control of imports, where there is a free imports, where there is a restriction, where there is a prohibition. The next point is where exports are promoted, how? Through various programs, various schemes, duty credit script, or like you may have some specified services, you get an incentive by way of a rebate or remission, right? So these are a couple of incentives which are given to exporters. Similarly, the foreign trade policy decides, can I import the goods without payment of duty? So I'm a manufacturer. I have to be competitive with the international supplier. Take an example for a moment. So I'm a manufacturer of this mobile handset. There are a few manufacturers who are there in China, who are there in Japan, who are there in USA. So I wanted to be competitive with those players. Then the Ministry of Commerce and Industry says, what can I do? They say, like I'll say, sir, there is a circuit, there is a chip, there is a electronic gadgets, a portion of my mobile I have to import, which is my raw material. If you can provide me to import without payment of customs duty, I can use it in my assembly, I can use it in my manufacturing process, I can export back, where my cost of operations are at par with the international competitors. So the Ministry of Commerce says, okay, let me think of giving a regulation for import of goods without payment of duty. Is it sufficient? Again, I'll come forward and say, so how about capital goods? I have to set up a particular plant. I need to have plant and machinery. So I have to import my capital goods, machinery for having a duty free. How does it help you? I would say that, look, I'm going to import this machinery, which I in turn use it as a process for manufacture, and I export back. Again, I have to be competitive with the foreign international player. Again, the government, the ministry can make policies in line with your nature of business. These four policies in relation to inputs, capital goods, those are implemented by another wing called Ministry of Finance by way of your Customs Act. So I want to have a nature of business setup where every time I cannot come for permission. Look, whenever I have to import, I have to come to the customs authority, the proper jurisdictional officer. I have to file an application. Rather, can you give me a blanket exemption kind of thing? Can you give me a particular setup where this inflow of goods, that is imports and exports, are hassle-free or lesser of my restrictions? Again, they say, don't worry. I'll come with a proposal called EOU or SCZ. Now, that is how, if you look into your GST law, Section 16, which talks about your zero-rated supply. Section 147 of CGST Act, which talks about your deemed exports. Supplies made to a SCZ, supplies made to a EOU, Advanced Authorization, EPCG. There is a recognition of these particular organizations in my GST law, in my customs law, by way of exemption notifications. So my FTP, Foreign Trade Policy, says, look, I'm not going to regulate SCZ because there is a separate act as such. I'm going to regulate something called FTZ, STPL, EOU, BTZ. So these are the various entities where they get a kind of blanket permission to operate with less of supervision, right? So these are the basic salient features with which the foreign trade policy has been framed. Now, administration of this foreign trade policy. My foreign trade policy, which was enacted by this Ministry of Commerce and Industry, this is regulated by this entity called DGFT. Who is DGFT? Director General of Foreign Trade. So this is particular, there is a separate act for enacting DGFT, which is the sublimation of your Ministry of Commerce. This particular entity takes care of framing the policies in relation to making the various amendments. So this particular DGFT comes with a policy called Foreign Trade Policy, which is generally governed for 5 years. So right now we have this 2015-20 policy, which was supposed to be lapsed in 2020. Because of COVID, it got extended by 1 year. By 2021, we are still continuing with this old policy of 2015-20. The new policy, 21 to 26, it is yet to be enacted considering your COVID parameters. Now, this administrative wing, DGFT, is going to take care of my foreign trade policy, which is going to have this 5 years tenure to formulate, to make a regulation of this particular policies. So what is there in this foreign trade policy? You have said that my DGFT is going to make the various decisions, and you have said that this particular foreign trade policy is going to be regulated by DGFT. What are the aspects which are covered under this particular DGFT? By the way, there is something called IEC, Import-Export Code. What is this Import-Export Code? This is a code like your PAN. I have a GST number which is connected with PAN. Similarly, IEC is one particular unique code, which is my 10-digit code. Examination, one mark MCQ question will be asked. IEC code is a 15-digit code. IEC code is a 12-digit code. Answer would be IEC is a 10-digit code. Now, IEC is must for getting into this regulations of DGFT related provisions. Now, so what can I see in this FTP, foreign trade policy? So as I said, 5 is the tenure generally with which this foreign trade policy comes into picture. For June 2022, you have this particular FTP, which is in vogue till 30th September 2021. So all the provisions which is there in your institute material, those are applicable for your June 2022 attempt. This foreign trade policy has got something called Handbook of Procedures. So I have 2 volumes. Like you have module 1, module 2, module 3, module 4. My foreign trade policy was brought as 2 modules. First module, this talks about your Handbook of Procedures, where it has got 9 chapters with respect to the procedural aspects of the policy. This each individual chapter, this identifies for whom I'll give a free hand for imports, for whom they can make a regulation for exports. What is the decision with respect to EPCG? What are the new schemes which are brought in? How the administration of this particular export needs to be done? How a particular assessee has to be given a benefit by way of a recognition of their contribution to the nation by way of foreign reserves brought in. So considering all these aspects, they have 9 chapters which are brought in volume 1. In addition to this, like we have the CGST rules, I have something called appendices and AANF form, Ayat Niryat form. Now, as we have rules like GST, my registration, returns, and various forms, all my policy matters are governed by this appendices and Ayat Niryat forms. The second volume, Handbook of Procedures. This is the hardcore of the trade policy. This second volume is covering SION, Standard Input Output Norms for various products. The technical term is called SION, Standard Input Output Norms. So the second volume is having the SION for various products. Based on this SION, the exporters are given a facility for making a duty-free imports of inputs. I import the goods, I process the goods, manufacture the goods, export them out of India. So for example, say I want to manufacture a handset, say mobile. My SION, Standard Input Output Norm, is going to talk. If you have this handset called mobile, this is having so-and-so tariff ID. For this particular mobile, this is the standard inputs which are required. Another example. Let's take example of your ATM box, ATM machine. So when I have my ATM machine, they say These are the spare parts. These are the inputs which are required to manufacture one ATM box. Third example. So I have to manufacture something called bicycle. Now, bicycle has got a particular classification. This bicycle needs various inputs. So I have to have tires, tubes, your steel rods, the rim buttons. Then I have to have some other chain kind of thing. So I have a inventory of list of items which is required for this particular output. So SION is the core which is going to determine an exporter who's going to export goods out of India. They're given a free hand to make an import without payment of customs duty. How do they know that? The moment I go to the customs officer and say, so this is my classification, they refer to this second volume and say, was there a classification for your product? Now, go to the simplest example. Every one of you are listening to me, you would have had a ceiling fan. Now, when you look at your ceiling fan, it looks like a fan. But when you go to the SION, that ceiling fan has got a classification of what are the inputs, standard inputs required. It requires, say, 3 blades. It requires a bearing. It requires a small compressor. It requires a wiring cable. Now, I have 4 to 5 components. So for every output called fan, these are the 5 output inputs required. So what I'll do, as a manufacturer, I'll go to the customs authority and say, sir, I'm manufacturer of a fan. This fan, they will look into your classification, say, oh, look, these are the inputs which I permit you to import. Based on that, my customs provisions are enacted. My guidance under customs, what can be imported without payment of duty and to what extent. Sir, let's take example of Bajaj Electricals. Bajaj Electricals have imported some particular items for the purpose of manufacturing of fan. Now, when you look at the Bajaj Electricals, when you look at their BOQ, means their list of goods manufactured, close to close, they have around 350 items what they manufacture under the brand called Bajaj Electricals. Every product which is manufactured by them will have a reference to SION. And a lot of science goes into fixing this SION. Now, how does it happen? It's not a book just written like that. They read the process. They visit the business premises. They understand the manufacturing activity. They look at your composition of inputs. They look the source of origination of those inputs. They understand what is the capacity installed you have. They also understand where are alternative sources from where this can be imported. Now, based on the goods which are exported by Bajaj Electricals, the parallel, backward calculation will be done. For a moment, Bajaj Electricals declares that we have exported, say, 5 lakh fans during the period April 21 till March 22 or April 20 to March 21. Once they declare that 5 lakhs is a goods worth fans have exported. Now, based on SION, I travel back to calculate what is composition of my inputs. This is what covered in my volume number 2 called Handbook of Procedures. And this SION, this is not something which has come recently. This is quite old enactment where earlier under central excise, whenever an audit was done under central excise, the excise authorities used to depend on SION. Why? The knowledge which comes from SION is enormous. I'll give a simple example. You can use this as a tool when you do your internal audit or statutory audit or any other assignment. You look at the nature of business, you look at the nature of manufacturing activity. Based on that activity, go back to this volume 2 of Handbook Procedures, look at the items they have listed out. They give how much is the process of inputs required, how much is the wastage, and on the basis of that, how much is the output manufactured. So, if you take an example, so there is a person who is manufacturing, say this, ATM boxes. Now, to manufacture, say 1,000 ATM boxes, how many sheets of steel is required. Generally, when you look into this manufacturing aspects, steel which is purchased is generally in tons. Now they purchase various steels, like they have HCR, HCH steel. They have CRCH steel. Means 2-3 variant components of steel. They buy that steel 6 mm, 8 mm, 9 mm, 12 mm, and various composition. That particular steel which is used for my ATM box, Sion gives a clarity how, on what basis this calculation will be used. Now, this is not static. This is a dynamic way. Every time there will be some updation which happens to Sion, because my business process is unique. 10-15 years back, when we look at your two-wheeler, Hamara Bajaj, the two-wheelers are made of steel. The weight of a bike is much heavy because of your steel components. If you happen to have this Bajaj, which is not 15 years back one, you could see the bumper, which is made of the steel one. You see the body, which is also made of steel. Now, these days, if you see after 2000 or 2010 onwards, all the products which is coming after 2010, these are all plastic components. So if you hit this Bajaj scooter to the TVS scooter will be having a dent much faster than Bajaj. Why? They have the steel components. The thickness is very high. Over a period, when the technology got advanced to usage of plastic and other components, so the fiber particles have replaced my production process. So that way, my Sion gets updated on a regular basis. This is covered in volume number 2. Then there is something called classification of import and export items, which is called ITC, which is in short called as Indian Trade Classification. We have studied under customs law called HSN, Harmonized System of Nomenclature. The same coding which is there in HSN, the same thing is copied in my foreign trade policy, but the term they use is ITC. It is not your input tax credit. It is something called your Indian Tobacco Corporation, input tax credit under GST, Indian trade codification, Indian trade classification. Now, this is the classification. HSN refers to Harmonized System of Nomenclature, relevant for my classification. Classification of goods, classification of services. So, ITC stands for Indian Trade Classification. Now, as we have studied under Customs Tariff Act, I have imports Schedule 1, I have exports Schedule 2. Similar to that, even in my ITC, that is classification under foreign trade policy, for Schedule 1 imports, Schedule 2 exports. This is also forming part of my foreign trade policy. You can refer to your institute material, page number 9.7. Come to your institute material, page number 9.7, where they have brought a broader outline called my Volume 1, Volume 2. So we have understood Volume 1, Volume 2. There is something called SCOMET. This SCOMET is part of your Schedule 2, which defines the special chemicals, organism, material, equipments, and technology. There are few items which are regulated by foreign trade policy, which is abbreviated as SCOMET. I repeat that, SCOMET once again. Even if you put on Google, you'll find the different abbreviations for SCOMET. Special chemicals, as the name goes, special chemicals or organism, material, M for material, E for equipments, and T for technology. So these are all special importance in nature, which are governed under your Schedule number 2. Now, this is my broad coverage, what is there in my foreign trade policy. Now, so you have explained foreign trade policy, what is there in the coverage. Students, this is all covered in your part 1. So I'm just briefing in a general layman language so that you can understand. So in the process of this foreign trade policy, assuming for a moment, foreign trade policy says that steel can be imported freely. My Customs Act says there is an anti-dumping duty on the steel. So there is a clash. Ministry of Commerce and Industry says, let it be free. Ministry of Finance and the Customs Act says that import of steel should be subjected to anti-dumping duty. Which one will prevail? Can I challenge the anti-dumping duty under Customs Act referring to the foreign trade policy? Answer is no. Absolutely no. Reason, my foreign trade policy is a policy matter. My foreign trade policy does not override my tax laws. I repeat this point. Again, a MCQ question, MCQ. Foreign trade policy has a benefit of overriding tax laws. True or false? Answer is false. Reason, foreign trade policy is just a policy. It doesn't have effect of overriding my tax laws, right? So I understand that I give a policy under FTP. This particular policy may be enacted by way of a Minister of Finance under GST law or your customs law by way of bringing suitable notifications of exemption. Now, moving on further. Now, aspects connected with my imports and exports. Now, all these aspects, what is there? Your Customs Act, what is there in GST? Like when we talk about GST, zero rated supply. When we spoke about your imports, we have discussed that my section 3 talks about your basic customs duty, your anti-dumping duty, that is your additional duty. When we talk about exports, GST talks about your zero rated supply, read with your Customs Act called Schedule number 2. All those aspects are more or less synchronization with my export-import policy, that is your foreign trade policy. So in general, they say exports and imports are free unless it is regulated. When I say the term free, don't imagine that imports are free of duty, exports are free of duty. It doesn't mean it is free. There is a regulation, there is a control. What is the volume of imports which can come into India? What is the volume which can go out of India? Simple example. Sir, export of rice, export of wheat, export of onion. Is it free? It is regulated. It is controlled. It is restricted. Export of electronic gadgets, laptop or any other items. It is free. That means they don't restrict. Export of arms and ammunition. It's either prohibited. Import of arms and ammunition prohibited. So when we talk about exports, your exports and imports are free unless it is regulated by your respective GST or customs provisions. Now, whatever policy was made under my Foreign Trade Development and Regulation Act, that has to be implemented in the tax laws by way of adopting suitable notifications. Now, so there is a doubt with respect to implementation of a policy. Say there is a duty credit script which is given for an exporter. My Customs Act has defined exports in one way. My foreign trade policy in relation to duty credit script explain one way. What I have to do? When you talk about a duty credit script, which is entitled under foreign trade policy, they say, please read your foreign trade policy. What was defined? What was the intent as per foreign trade policy? That shall prevail. Next. Look at your page number 9.10. Look at your page number 9.10, where they are talking about your export-import policy and procedure and principles for restriction. So here they say that they are going to brief who are the class, who are the category of persons for whom this provisions of foreign trade policy are applicable. And when it is applicable, they impose exemption. They impose conditions. They also give a free hand. Now, all these are regulated by way of your IEC connected with your nature of activity. Now, so how does this particular policy matters are regulated? Now, there are few aspects like they restrict on the basis of your protection. They restrict by way of prevention. They also protect by way of conservation. So they protect the public morale. So there is a sugar which is getting dumping into India. So there is a rice which is getting dumped into India. Now this sugar, this rice has got an element of plastic. Now which is against the health, which is hazardous to the human. So they protect the public morale. They also protect the human, animal, or plant life or health. Now there was news few years back saying that Chinese egg. You have this particular rice. If you a few places we have seen pre-COVID, they have this basmati rice or some rice which is imported. If you cook say 1 kg, normally 1 kg of rice is sufficient for say 10 people. This particular imported rice can be easily served to 15 to 18 people. How it happens? This rice has got so much of fiber content, it does digest easily, and also intake capacity will be reduced. Now what happens? People who make business, they try to induce those kind of imports. Now those cases, the policymakers says, look, I'm not going to sit quiet. I am going to regulate. Similarly, protection of your patent rights, protection of trademarks, copyrights. They try to protect the interest of your Indian trader where there is an international trade to protect the components manufactured in India. Now you would see most of these goods which are exported out of India, there's a certification. This certification called Make in India. Like when we read this aspect called anti-dumping duty. When the Customs Act comes with a notification saying that any goods which are imported from, say, Burma, this is the restriction or this is an anti-dumping duty. So how do I know that these goods are manufactured from Burma? The goods which have landed, it got packing material which says make in Burma, make in China, make in Singapore. Similarly, your Indian exports also have this particular mechanism, the trademarks, copyrights, and regulation, make in India concept. They regulate, they protect the interest of the exporter. When there is an international trade matters, you get your rights, you get a preferential rate, you get also priority on the goods which are exported from Indian origin. They prohibit arms, ammunition, implements. Now, if you see your baggage rules, we have seen that Annexure 1 the other day, where Annexure 1, they have given that these are the list of goods I give a duty-free baggage. So there is a prevention, there is a prohibition. These are the aspects which are connected with your imports and exports. And please remember one thing, any duty script, any claim for authorization, any policy which is under DGFT, it is a right vested with the DGFT authorities or concerned regional authority, and it is not a fundamental right or a constitutional right to the businessman. So the businessman cannot challenge the policy of a foreign trade policy in courts of law saying that so the policy is against the practices. This policy is protecting only a set of businessmen. Now, policy framed in the foreign trade policy, they have a right to frame a policy. This policy cannot be so challenged under customs, under courts of law. Moving on further. Status holder. Now, this is one concept which has got importance over a period of time. Most of you who don't have an experience or exposure, you go back to your assessee, your client and ask, say you have been doing exports for last 4 years, last 5 years. Do you enjoy this status holder certificate, status holder category? You ask them, which status you having? Is it 1 star, 2 star, 3 star, 4 star, 5 star? As of now, 5-star status is given. Based on the volume of exports in repatriation of money into India, they have classified the businessmen into this 5-star category. Based on each particular category, they have certain free incentives, freebies kind of thing for the purpose of foreign trade. I'll give a simple example for you to understand. Whenever goods which are imported into India through aircraft or vessel, there is something called inspection, there is something called physical verification. In general, any consignment which lands at the customs area, it takes on an average 2 to 3 days for inspection come verification. Reason, the customs authorities open, they verify, they examine, and then they give a report. Classic example, I gave my own example. 2008, I have imported a particular laptop. This laptop which has come through customs, this has come in a open, a seal was broken. However, there was a counter seal from the customs where along with my bill of entry, I was given something called inspection report, where they opened the box, they verified what is there inside the box, looking at the contents as per the invoice, looking at the contents which are physically available, they close back. In their presence, it was sealed. So there was an inspection report given for this particular physical verification. Now, if it happens as a routine practice, my customs, my material gets held up at port. Now, assuming 2-3 days it will take for verification. From there, payment of duty, clearance and all, it will take another 1 or 2 days. So there is a time consumption for clearance. So to avoid those particular aspects, they have given a free hand. If you are having a 4-star, if you are having a 5-star status, you can have a self-declaration. That means my customs officer, my proper officer, he will freely permit my material for export or import on self-declaration basis. What happens? I declare saying that the contents of that particular box, the contents of this particular consignment are true to the invoice which I have provided with. Now, this is a reliance placed on basis of my status holder. I have few aspects discussed at length, which you understand down the line, importance of status holder concept. Last but not least, we are going to discuss on duty exemption remission schemes under foreign trade policy. Now, when we talk about this duty exemption and remission, there are various modes how the customs are going to give incentivize, going to give a free hand in terms of my imports and exports. The broad outline of these aspects, I'll just show you. Yeah, come to page number 9.23. 9.23. Institute material, page number 9.23. Now, this particular aspect of duty remission, duty exemption, and duty exemption, duty remission is broad coverage of my foreign trade policy. So what do they say? Like Customs Act. In Customs Act, applying section 25, I give a absolute exemption. I will give a partial exemption. When you export, there is an applicability of duty. When you import, if you happen to be SEZ unit, I give you an exemption. So similar to that, my foreign trade policy says, look, as per my policy, I give you something called upfront exemption. This upfront exemption is covered by way of advance authorization, duty-free import authorization. Next aspect is duty remission. This duty remission is covered under customs law. It is not covered under foreign trade policy. Page number 9.23, students. My duty remission is covered under Customs Act. How does the duty remission happens? By way of a duty drawback. In the last class, we have discussed Section 74, rebate of duty drawback of the duty in relation to those goods imported as is exported with the identity established. Similarly, Section 75, goods which are imported, used in a manufacture-related activity, subsequently which have been exported. So under Section 75, the element of customs duty, the element of central excise in those goods, that is imports, which have been used in the process of manufacture and in the finished product which is exported out of India, I get a remission by way of a duty drawback. So foreign trade policy just refers to duty remission. This is administered by Customs Act under Section 74, Section 75. Now, there is one new concept which was brought in effective from 1st Jan 2021, which is called remission of duties and taxes on export products. In short, it's called RODTEP. Examination, expect one theory question from this aspect called RODTEP. There is a separate slide. I'll give you in broader understanding what is covered under this particular scheme. Now, let us understand this status holder concept. So why do we read this status holder? It gives a glimpse of you to understand what is the importance, how you can guide as a value addition. Let me see if there are any questions before we go further. Namita is asking this question. So in page 6.6, fourth point, clearance of exports required the satisfaction of AC or DC until clearance obtained AC/DC not satisfied. See, this satisfaction of AC/DC, point of clearance of export, the goods have to be exported to the satisfaction of AC or DC. This continuation, so manufacture and a bond, raw material can be imported without payment of duty. Please explain. Yes, Namita. So here, when we talk about my exports to the satisfaction of AC or DC, this aspect, to explain, let me start from the factory. Generally, the goods which are meant for export, these goods doesn't have duties or taxes. IGST, SGST, CGST. If the goods are sold within the India, I have to pay taxes to the government. Now, these goods, when I say it is meant for export, the identity of the goods, where there is a packing list, where there is an invoice, and the respective other documents which is meant for export. The goods have to reach to the customs place. Now, I'll give you the example this way. Say I'm a manufacturer. I manufacture something called cable. Now, these days, most of you would have seen, you have this internet broadband connection at your home. COVID has made a lot of change where earlier we were having only this dongle or mobile hotspot. But for having better office work executed, most of us have these cables, that is your broadband, the machine, this particular broadband machine. Along with that, you have this LAN cables kind of thing. So this particular box, which is meant for your broadband and the cables, I manufacture these particular equipments. I manufacture the box, which is meant for your broadband connectivity, and also cable called connector. Now, these components I manufacture and I export. Now, to manufacture this particular cable, what I do, sir, I import a wire from Japan. This particular wire, which comes to my premises, the wire comes in, say, 100 meters. I cut the wire into 5 meters, 5 meters, 5 meters, small cables, and at every end, that end, this end, I connect something called connector. What is that connector? I cut open the cable, I insert that particular plastic case and pierce that so that it becomes a cable. I just do this process. I cut the ends, I put the plastic assembly connector, I press upon, I manufacture something called cable connectors. Now, the cable which was imported into India, the same cable which is manufactured and being exported. Now here, when I cause the material to the customs port, the customs officer would not know when I have imported that cable and when this cable is going out of India. So what happens here? I have to give a description of these goods. I also have to connect this particular export consignment with my import consignment. Why should I do? So when I have imported the cable, I took a permission from Customs Authority. What did I do? I took a blanket approval saying that, so this cable I'm going to export back. So here I get a license, I get a permission. The reference of this license, the reference of this particular permission, I have to mention on my tax invoice. I have to mention on my commercial invoice. Something else called shipping bill. This shipping bill should consist of my name, my GST number, my IEC. Look at your customs documentation. IEC is must in addition to your GSTN if you're registered. Why? IEC is connected for DGFT. GST is connected with my compliances of returns. So here, when you talk about satisfaction of AC or DC, the goods which are manufactured from a factory, now that factory, it should reach customs place. So what if I have the same business executed at two places, one in Tamil Nadu, one in Kerala. Kerala unit is completely export-oriented unit. Say Tamil Nadu is a domestic unit. What if the goods are imported at Tamil Nadu? What if the goods are imported at Kerala? Goods imported in Tamil Nadu are meant for domestic. Goods imported in Kerala are meant for export. If at all, the goods which are imported at Kerala are transferred to Tamil Nadu. From there is a domestic clearance done. Now, how does the officer get to know how much is the value of imports you have done? How they can correlate with the value of exports? Now, SION, SION. For connectivity of that particular aspect, Namita, satisfaction of AC and DC, there are various aspects. They examine all these contents. That's how this aspect of verification comes into picture. And with respect to this bond, raw material can be imported without payment of duty. Wait for another 10-15 minutes, Namita. I'll explain this concept of import without payment of duty. Now, this aspect called status holder. This is for business leaders. When I say business leader, it doesn't mean it is on the basis of your value of exports. I cannot compare a small software company which is next to your street with Infosys to say Infosys is big and this unit is small. SME is also business leader. Infosys also business leader at their level of operations. So here, my status holder, it is a resemblance of a business leader who excelled at their capacity in international trade. So what do they say? My status holder is a recognition given to whom? Business leader who have did well in their international trade. How? They have contributed to countries' foreign trade. They have contributed to countries' foreign trade. Example. So when COVID hit every nation, when COVID has hit every nation, imports, exports were at standstill position. But at that point in time, there are few industries who have really turned out well as a green belt, who have done fantastically well to upkeep the foreign trade, to upkeep your import and inflow and outflow of foreign currency. Example, pharmaceutical industry. Example, power generation entities. So here, they have recognized, they want to incentivize those businessmen who have contributed towards foreign trade. So all exporters of goods and services in technology. So they're saying that goods, services, and technology. These three set of businessmen who have an IEC and whose number is eligible for recognition as a status holder. The status recognition is depending on their export performance. So they have identified that, look, I'm going to give you something called status holder. This particular status is on the basis of you giving contribution back to the economy. So here I can be qualified, I can be quantified as a status holder upon achieving your foreign performance during current and previous 3 financial years. For me to get into this status holder certificate, I have to prove my performance in the current year and the last 3 years. How? On the basis of my export performance, which is on the value on the basis of FOB or FOR, which is on the basis of my FOB or FOR, which is a value designated in foreign dollar in millions. So they say, if I have met 3 million US dollar, I'll be called as 1-star house. For calling 2-star house, I should have 25 million US dollar worth of FOB or FOR exports to be made. 3-star, $100 million. 4-star, 500 million US dollars. 5-star, 2000 million US dollars. Now, this is the way my value of exports is calculated. I don't know how many of you have given a certificate in your internship. The people who are into manufacturing activity, they take a certificate from their auditor. It could be a statutory auditor, it could be any chartered accountant in practice. Based on the turnover, which is your export turnover, they get a certificate from a chartered accountant, which will be furnished to the regional authority. Regional authority is the concerned DGFT authority who examines your export turnover, and on the basis of your export turnover, they give you something called star status. And sir, you're talking here something called US dollar. How do I calculate US dollar? Because there is something called spot rate. There is something called average rate. There is something called closing rate. Spot rate when the transaction takes place. Average rate for the entire year. Closing rate is end of the financial year. For this calculation, they say, take as on 1st April of every year. On 1st April of every year, the rate which is notified by customs. My customs authorities notifies the foreign rate, exchange rate. So the rate which is notified by customs or as on 1st April for every year, that will be taken into consideration for converting INR into the dollars. So based on your this turnover complaints, you will be issued something called status holder. Now, so I will be given this category on the basis of FOB value of exports, free on board, and earnings in free foreign currency. Now, earnings in convertible foreign currency, earnings in free foreign currency. I can take into consideration both aspects. So what is that foreign currency? Money which is coming from a foreign bank through a nostro-vostro account, which is held by a non-resident bank. Convertible foreign currency naturally comes from a foreign soil. Or there could be transactions where money comes through a vostro account through a designated non-resident bank. So any money which has been repatriated will also be taken into consideration. For deemed exports, just wait for another half an hour. I'll explain this concept of deemed exports. The concept of deemed export where the goods doesn't leave India. The goods reside in India. However, the goods which are supplied to a person called EPCG holder, Advanced Authorization, DFIA or SCZ, those are the people who in turn export out of India. So it's called indirect route. I take for deemed exports FOR value, free on road value. For exports, I take FOB value. For deemed exports, I take FOR value. Again, examination 1 mark MCQ question. For calculation of status holder certificate, export transactions, value of CAF will be taken, value of FOR will be taken, value of FOB will be taken. So for exports, FOB value. For deemed exports, I take FOR. For value, where the value is in INR, it will be converted into dollar on the basis of the value which is prevailing on 1st April. So what they say, so to give a status, I look into your past performance. At least 2 out of 4 years, you should have this foreign transactions. So I have very active 2018, 2019. I was silent in 2020, 2021, 2022. Now they say, when you look at 4 years, at least 2 years, you should have this export performance. I have only 1 year out of 3 years, then they say you're not entitled for. Now, this transfer of one IEC holder to another IEC holder. Now, there was a mechanism where, I'll give a simple example here. There is something called net foreign exchange. So what if I have not met with my net foreign exchange compliance? As a EOU unit, I was supposed to make exports. Say entity A, entity B. There are 2 entities. Entity A is doing fantastically well. Entity B is not so capable of doing. So here, entity B may be shortfall of their net foreign inflows, foreign currency inflows. Those cases, entity B can make a supplies to entity A to get regarded as for that positive NFE based on the approval permission given. Similarly here, when I want to club this particular transactions, the same export performance of one IEC cannot be transferred or clubbed to another IEC holder. Moving further. Now, in the process of doing the calculation, so there are exports which are made on re-exports. In April, I made an export. It has come back. Again, in June, I made an export. The second export will not be taken into consideration. Export of those items which are under advance authorization or including SCOMET items would be included for calculation of export performance. Like I said, deemed exports. When I say under authorization, my advance license or your DFIA, those cases also will be taken into consideration. Sir, I exported 50 lakh worth goods to foreign nation. I sold 20 lakh worth goods to this advance license holder. For the purpose of this status holder to say exports, that 50 lakhs, this 20 lakhs, both will be taken into calculation. Now, for this 1-star export house category, there's a importance given to someone called MSME. What they say? For these MSME holders, there will be a double weightage to encourage this what you call MSME. Those entities who have registered under MSME. At this point, I will make one recommendation. If at all, if a assessee is doing a manufacturing activity, trading activity, service activity, please recommend the businessman to get a registration under MSME and also to get that Udyog Aadhaar number. Reason, there are many incentives under banking regulation, many incentives under your protection of interests of a small business by various public sector undertakings. Third, participation of these MSME in trade exclusively where 20% or 10% there is a reservation to MSME business sector. Fourth, with respect to some exemptions provided by way of clearances of imports or exports. So this MSME is of very, very importance in the business scenario. Coming back, those units who have ISO or BIS. BIS stands for Bureau of Indian Standards. So those organizations who have ISO certification, who have Bureau of Indian Standards, they will be getting a double weightage to encourage their star status. Those units which are located in northeastern states. Now, northeastern states, getting a industry established is very difficult. How do they promote? They promote by giving incentives, which is called northeastern states. Earlier under central excise, there was something called preferred location. Any company which comes and sets up a unit in northeastern state, there was a complete waiver of excise duty. That was a golden period where this northeastern states and some portion of the northern states, especially the rural areas, they get a facelift where a manufacturing setup comes into a particular rural area. Naturally, infrastructure will be developed, employment will be developed, the surroundings education skills will be developed, various business connects will be developed. So to promote that way, foreign trade policy, they say any units which are operating from this, we try to give a double weightage in terms of calculating your star status, also including Jammu and Kashmir, Sikkim. Units which are operating in an agri-export zone. Now, so why do I look for privilege? I gave few examples earlier. Authorization for customs clearance, that is on self-declaration basis. Examination, 4 marks theory question. Examine the privileges available for star status holder under foreign trade policy, where you will give self-declaration. My customs clearance can be made easily on the basis of self-declaration. That means verification of documents will be done. Physical verification of goods unless there is a specific, unless there is a possibility of some misfeasance or fraudulent activities there, they will not open the boxes concerned. And fixation of SION maximum within a period of 60 days by norms committee. This is a greatest important aspect reason. My advance authorization, my DFIA, another 10 to 15 minutes, I'm going to touch upon this important aspect called DFIA. That take something what you can take back from this session, students. You can go back to your clients and you can examine their business model. You can come with this particular new suggestion, which can save some value of money by way of this authorizations on the basis of their business model. So here, SION is something which is compulsory, which is mandatory for these particular schemes. So what if, for my nature of business, this SION has not been notified? I can make an application to this norms committee, who will in turn fix something called SION. Then exemption from compulsory routing and negotiation through bank. I don't know how many of you have experienced this particular practice. All the documentation, all this particular execution of your LC, usance documents, negotiable instruments, bill of lading. There is an execution done by banker, and then those documents go to the customs authorities. Banker plays a prominent role in terms of your imports and exports. So the goods have come to India. Intimation of that goods to banker, by in turn, remittance of that money to the foreign party, intimation to RBI for FEMA guidelines. Goods have been exported out of India, getting a GR waiver where the goods are going to be sent on a FOR basis. Again, tagging of this information on RBI website. The money which has been repatriated, intimation to the banker, getting your LC executed, getting your bills discounted, execution of documents with the foreign party. All these documentation generally gets routed through a banker, where banker plays a prominent role. Now, what they have done, look, if you're a status holder, I'll get away with all these formalities from the bank. Rather, you yourself can do a self-declaration mode. You can get into the international trade. Then, furnishing of a bank guarantee. Now, this is very important aspect under foreign trade policy. Now, under GST or customs, you would have heard something called provisional assessment. When there is a provisional assessment, I pay the duty on provisional basis, which is not finalized, which is not ascertained. Now, those cases, generally, there is a security to be given. So similarly, under foreign trade policy, wherever there is an exemption, wherever there is a duty credit script. Now, to protect the interest of this particular DGFT, they insist to have a bank guarantee. Now, this bank guarantee is a waiver for a status holder. That means they can get a permission from the RA without giving any bank guarantee. Now, whenever there is a bank guarantee, students, there is a working capital blockage. This working capital blockage can be done away by getting into status holder certificate. There are various aspects, like there is a RA. that is your regional authority. There is one more authority called RCMC, where registration cum membership certificate, where STPA or various organizations, they give these permissions. Now, all those aspects were kept outside your institute material for the simple reason, let students know the benefits, then they can advance themselves once they get qualified. So as of now, you can understand that bank guarantee is not required. Now, setting up an export warehouse, one of the prominent business model, setting up an export warehouse where goods are stored without payment of duty. Bonded warehouse. Generally, when we say warehouse, it is a bonded premises. Getting a permission for export warehouse is not that easy. So you get a permission being a status holder. More than that. See, you as a manufacturer, I was talking about something called Make in India concept. When I say it is Make in India, there are few incentives which are provided for this Make in India. So here they say, whenever you establish yourself that you are doing this particular activity called manufacturing or assembly in India, you can use this concept called Make in India. Based on that, people who are having 3-star and above, they get a self-certification process of their manufactured goods. Means I, as a manufacturer, I can put on my boxes as Make in India. All my documentation will also have Make in India. These are the goods which are originating from India, and they get a preferential trading agreement for the clearances, free trade agreements for the purpose of formalities in the other nation. I'll give an example. When goods are exported from India to say Kazakhstan or Indonesia or to say Japan, based on your preferential trade agreements between two nations, they get something called preferential trading. They get a subsidy, they get a formalities clearly, they get some sort of clarifications, intimation, information, all these aspects freely available. Example, so I want to have some consignment book. I need to know what is the policy for this particular goods which are being exported, the goods which are getting cleared. Is there any concession? Is there any dumping? Is there any countervailing duty for these goods which are originating from India? Now, these are all by way of your preferential trade agreements for goods which are having Make in India logo embossed by themselves. Now, in addition to that, I have FOC exports. There's some annual limit. Generally, goods up to a sum of ₹5 lakhs, I can make an export without any permission. Beyond that, there is a permission to be obtained from the RA concern. Now, let us start with this first aspect called advance authorization under foreign trade policy. Let me see if there are any questions before I come to this advance authorization. So far, so good. Now, advance authorization scheme. This is a scheme which was brought in to provide a mechanism for exemption from payment of duty. That means the duty which is payable on import of inputs. When I have an advance authorization, this is given by DGFT. So what happens here? I go to the customs authorities and say, sir, look, I'm going to import a consignment which is used for my manufacture. In turn, I'm going to make an export. I give my basic process of manufacture. I explain what is the industry I come from. I also give various documentation available with me. Now, based on that, they'll say, Praveen, I'll give you advance authorization for 10 lakh rupees. This particular advance authorization is as good as my bearer check. I can clear the consignments without payment of various duties. I can clear my consignments without payment of BCD, additional customs duty, anti-dumping duty, countervailing duty, safeguard duty. That means to say, my customs authorities, now please understand how it works. For a moment, let us assume that Priya is a person who is going to import the material. Priya happens to be a business person in the state of Maharashtra, say Pune. She will have someone called RA, the regional authority under DGFT. This regional authority will examine the business model of Priya and she will say, look, you have given all the relevant documentation. You have explained the business process. You say that these goods are going to be used in a process. In turn, the finished product is going to get exported. Now, what is the value you are going to import? Priya gives a declaration, sir, I am going to make an import worth around, around 1.5 crore. On this 1.5 crore, the equivalent duties payable is, say, roughly around 25 lakhs. Now, this 25 lakhs, I may use in one shot or I may use in multiple consignments. So here, DGFT authorities give something called advance authorization. When I go to the customs for clearance, my customs authorities raise a demand for 25 lakh. What I do, I give this certificate, I give this authorization, which is given by DGFT saying that, sir, I was permitted to import the material. I was permitted to import the material for use in a process. In turn, I can export. So here, the customs authorities are going to debit this particular certificate saying that authority has given 25 lakhs, the duty levied, say 22 lakhs, they debit 22 lakhs and the cost clearance of goods. Now, is there any value of cash outflow happening? There's no cash outflow happening. There's a value of 22 lakhs where I have admitted that I have to pay provided I use in manufacture and in turn I export. Now, this advance authorization, generally a bank guarantee will be sought for money equivalent to that. So what if I'm a status holder? No need to give a bank guarantee. This advance authorization I can use for payment of my BCD, additional customs duty, ADT, CVD, safeguard duty. Goods are exempted. That means I need not pay. And the time limit. The day when advance authorization is given, from that day, within a period of 12 months, I have to use this particular authorization. That means I have to cause import of goods and then I have to use this particular certificate consent. Now, what if this advance authorization, I want to use it for deemed export supplies. I want to use it for deemed export supplies. That means EOU related aspects. Instead of 12 months, they will see what is the duration of project for this deemed exports. Whichever is later, that will be taken into consideration. If the advance authorization is used for deemed exports, which is in relation to a project, the permission given for that specific project or period of 12 months, whichever is later, that will be taken into consideration. What do you mean by this duration of project? I get a permission for the purpose of this deemed exports. Deemed exports, goods doesn't go out of India. However, that particular person who is receiving those goods in turn make a export out of India. Now, so everything is good. I have imported the material. I have enjoyed the advance authorization. You have said 12 months. I have done. What next? Now, there is something called export obligation. I look at the term called export authorization. What is this export authorization? I, as an importer, I was given a duty exemption, right? Whatever duty I have saved. Now, in this example, what we spoke, Priya has imported the consignment, that is inputs worth 25 lakhs. Now, she has to ensure that she is going to cause an export of those goods out of India under this advance authorization within a period of 18 months from the date of issue of this authorization. So the goods which have been imported with advance authorization, I have to process them and then I have to cause an export to fulfill my export obligation. Now, this is to the satisfaction of concerned ACDC. Now, here I was referring to something called SION. Right? For this particular advance authorization, what happens? Sir, I have explained the nature of process. Like, when Priya gives the documentation, she says, so if I import 10 lakh units, I manufacture some 8 lakh worth units. So this 10 lakh units, after processing, it becomes, say, 8 lakh units. X, Y, Z are my inputs. My finished product is called, maybe say A. For 3 components of input, I have an output called A. So if I have 10 lakh input components, I manufacture something called A of 8 lakh units. I have this A of 8 lakh units. So here they refer to CION, and to ensure that whatever goods have come for export, there is a declaration, there is a correlation. So when I come to export, what do I say? I have a tax invoice, I have a commercial invoice, I have a tax invoice, I have a commercial invoice, I have a packing list. I also have a bill of lading. So all this, finally I have something called shipping bill or bill of export. All this documentation, what will I do? Say for a moment we are talking about Priya, who happened to be an importer. On all this documentation, I quote my authorization, that is the license number. Sir, I imported the material under this authorization. So this authorization number I quote on my tax invoice, my packing list, commercial invoice, bill of lading, and your shipping bill. To say that, to comply with CION. Now, when I add all those consignments together, I establish my requirement of export obligation. And export proceeds. Once I export, the money should be realized in freely convertible foreign currency. Convertible foreign currency. If I don't receive this money in convertible foreign currency, violation of my FEMA regulations, then they say that whatever advance authorization was given, it will be presumed that you are not complied with your export obligation within the given stipulated period of 18 months. Then I recover that particular money along with interest and penalty. So in relation to SCZ, when I make a supplies to SCZ, now deemed exports is a different, SCZ is a different concept. SCZ has got a separate act called SCZ Act. Under my foreign trade policy, they say that any goods which are exported to a SCZ unit, though SCZ unit is within India, it shall be taken into account for discharge of export obligation. So my activity of manufacture, in turn, I supply to SCZ. It will be deemed to be called as a export obligation, discharge of export obligation. How they say that money to be released from foreign currency account of a SCZ unit. So in case of SCZs, they have a foreign currency account. The money from that foreign currency should come. Now in this example, Priya has got her factory in Pune. When Priya is making a sale, for a moment, let us assume that there is a person called Naveen. Naveen is in the state of Kerala. Naveen is a SCZ unit. So when Priya from Pune sells goods to Naveen in SCZ, Naveen has to make a remittance to Priya in convertible foreign currency from the respective SCZ unit. So what if I get in INR? It will not be considered for your export obligation. Now, alternative to your SCZ unit, I have SCZ developer or a co-developer. Now, this is an exception. In case of a SCZ developer or co-developer, when Priya sells those goods to SCZ developer or co-developer, it will be considered for discharge of export obligation, even if the payment is realized in INR. So they say that SCZ unit, foreign currency. SCZ developer or a co-developer need not be in foreign currency, even INR is good enough. Right? So examination, 1 mark MCQ. Mrs. XYZ Limited have imported goods under advance authorization. They caused the goods manufactured from their factory to a SCZ unit. They have considered the supplies to SCZ unit for discharge of export obligation where money was received in INR. True, false? You will say false. Reason? Money from SCZ unit should have been received in the foreign currency. This is one important point for SEZ unit. For SEZ developer, I need not have a foreign currency. I can just use my INR. Under advanced authorization, inputs which are physically incorporated in export product. Now, there should be a existence of those inputs in my export product. Now, it becomes challenge when a same entity has got 2-3 locations. Example, I was talking about this connectors. There's an entity called ABB Limited. There is an entity called Schneider. These organizations, GE, Schneider, GE, or ABB, they have their presence in India. They also have a global-wide presence. Assuming for a moment, I'm a job worker for Schneider. Schneider has operations in, say, India. Schneider also has got operations in USA. Now, it becomes challenge how I am a manufacturer of cable connectors. I have my unit in Rajasthan, which is catering to Indian business. I have a unit in, say, Tamil Nadu, which is solely meant for USA. Now, the question comes here. The goods which are imported at Chennai or Tuticorin port in the state of Tamil Nadu without payment of my duty, what if those goods are diverted to Rajasthan where consumption is happening in Rajasthan? Why? All manufacturing activity from Rajasthan is catered to domestic Schneider with payment of IGST. Now, this particular Rajasthan unit will import with payment of duty. The unit which is there in Tamil Nadu will import without payment of duty. Now, establishing the nexus of those duty-free goods in the goods manufactured and exported. Reference to SION, reference to non-utilization, crisscross is a challenging task for establishing my export obligation. Moving further, what else I can import? I can import inputs, okay? I can also import something called fuel oil catalyst, which are consumed or utilized in my export product. When I say fuel, like example, you have this petroleum products. I can import those petroleum products without payment of any excess duty or relevant customs duty. Then mandatory space, which are required to be exported or supplied with resultant product, which is permitted to 10% of CAF value of authorization. Now, I have an authorization which has got a value. What they say, this value, when I give inputs to the officer concerned, sir, I'm going to import 2.5 crore worth material, which is called CAF. On 2.5 crore, 10% happens to be 25 lakhs. Now, why do we have this mandatory space? There are few components where it is a basic expectation that along with the finished product, the spare parts are to be provided. Example, when I purchase a laptop, I have a power cable, which is called space. Now, say I manufacture laptop. I import the power cable. This power cable, was it used in the production? It is not used. It is being sent as a space as it is. Now look at the beauty. Goods are imported, the same goods are exported. Goods are imported, the same goods are exported. Now there is no manufacturing activity happening. There is no production happening. So here they say, I curtail your mandatory space to the 10% of CAF value. When you are selling a product, along with the product, you have to give space, without which the machinery is of no use. I have taken that into cognizance and I permit to 10% of CAF value. Again, examination 1%, 1 mark MCQ question. In case of advance authorization, mandatory space are permitted up to 25% of FOB value. False. In case of advance authorization, the mandatory space along with the exported product is permitted to the extent of 10% of FOB value. Now, the moment I say exports, generally we think of FOB, but here the authority is not giving on the basis of your export value, is giving on the basis of the CAF value of the consumables, the value of goods which you are importing on that CAF value. So when I talk about import, CAF value should come into your mind. So in the case of my band-aid spirits, 10% is my ceiling. Next. This I'll skip, not much of relevance. Now, value addition. They expect that whatever goods we are importing into India and those goods which are incorporated and exported, there should be a minimum of 15% value add. Let me come to my Excel file to make you understand with this particular value addition. Now, in the case of value addition, they say that my value addition is equal to A minus B into 100 divided by B. They have given a formula saying that your value addition should be minimum 15%. Minimum 15%. How do I calculate this? My A indicates A is your export value. FOB, value of exports realized in foreign currency, released or received. Now, when I talk about realization, please keep in mind, realization can be in foreign currency, realization can be in INR. Deemed exports, SEZ developer, SEZ co-developer, INR. SEZ unit, foreign currency, export, foreign currency. So A, whenever I talk about export students, FOB value. Whenever I talk about import, CAF value. Next, B. My B is CAF value of inputs covered by authorization. Now, here there could be a possibility that I could have, I'll come to that free of cost material little later point in time. Time being, they say that, look, I've permitted you to import 2.5 crore worth material. Your export should be at least minimum 15%. So here, CAF value of inputs is, say, 2 crore 65 lakh. And my FOB value assuming my FOB value is 2 crore 90 lakh. Now, applying this formula, what I will do? A minus B. A minus B into 100 divided by my B, that is 2 crore 65 lakh. I get 9%. So the government says, look, you have brought 100 units, you have consumed 100 units. Where is the value addition? You brought 9%. This 9% could have been achieved even in India. So they say you should be in a position to at least fetch 15%. Not acceptable for advance authorization. So they say that, look, you have done your business. I understand you, but what you have done is not so good. I don't agree with you. So this is scenario 1. Scenario 2. Assuming 2 crore 65 lakhs I have purchased, and 3 crore 20 lakh I have been able to export back. Now, same, if I apply, I get 21%. Now, other manufacturer who has into the same business, they'll see, look, 2 crore 65 lakhs is what you have imported, and you could have fetched 3 crore 20 lakhs. You made a value add of 21%, which is in line with my advance authorization. So this is how they permit you for advance authorization called value addition. This value addition, minimum, they have an expectation of 15%. So what if I do better? You're saving money, you're getting money back to India, you've done fantastically well. So this is a basic expectation. That means any business you do, ensure that you have that margin of 15%. Now, this advance authorization, I said, basis for me is CON, and it should be notified. So what if the CON is not notified? Make a self-declaration, go to the norms committee, get the declaration, your CON fixed by norms committee. Now, this advance authorization I have. Now, let's take this example a little further. I say that Priya has imported the goods for use in manufacture and she has exported. What if, say Priya imports from Schneider, USA. Can she purchase from Schneider, India instead of importing from USA? How does it help? So from USA, there is an insurance, freight, loading, unloading, and a lot of formalities. If I buy from India, I get the same price. Like there, it is per unit, assuming $320. In India, it is say $325 or $340. So when I do conversion calculation and all, I could save little time, I could save little money if it is purchased from India. So they say that, look, you have an option to procure those materials or inputs from indigenous. That means within India. When you're buying those material, I don't insist you should always import. You can also buy from India. That is a manufacturer or STE. We say that there is something called state trading enterprise. So the goods which are permitted for sale through STE. So I can buy from a manufacturer in India or from a STE instead of import. How does it happen? Against advance release order or invalidation letter. Now these are technical terms. What it happens? My regional authority gave a certificate to Priya to import the material. Now she'll go back to the regional authority and say, sir, please make a invalidation. Instead of being imported, I buy from domestic. So this is called invalidation or advance release order. Instead of import, you gave a permission for import. I would like to make a change by way of invalidation, saying that I can procure locally. This is a mechanism where I can get permit to buy even within India. This is called your deemed exports. Means that party who sells goods to Priya, who happens to be a manufacturer in Pune, in turn Priya is going to export the material out of India. I'll extend the same example this way. Naveen is a manufacturer in Kerala. Naveen is a manufacturer in Kerala. Priya is a manufacturer in, Pune. Priya will show this advance authorization to Naveen and say, Naveen, please export that material, please send the material to me without duties or taxes. Now, under GST law, there is a specific provision 147 which deals with your deemed exports. So for Naveen, any goods which he sells to Priya, it's called deemed exports. Why? Instead of Naveen exporting out of India, Naveen sells to Priya, Priya is exporting it back to foreign nation. So here Naveen gets a benefit of that advance authorization where he charges GST, claims a refund back from the department. So what happens? Naveen will charge IGST to Priya. Priya will pay only the basic value to Naveen. Naveen will pay that IGST to the government, claim a refund back from the department. Why? Because my foreign trade policy says that this advance authorization should be given as a deemed export entitlement, and the person, the Priya who is holding AAA, will export back out of India. Now, this is the connectivity of my policy under foreign trade policy, which was brought into my GST law called deemed exports. Now, once I complete my export obligation, sir, I have, you said 15% minimum value addition is required. I did that. What I have to do? The RA issues something called EOD. See, Export Obligation Discharge Certificate, EODC. He relieves Priya from the obligation of this advance authorization. Export Obligation Discharge Certificate, or otherwise it's called Redemption Certificate. I'll draw your attention over here. Getting a EODC, getting a redemption certificate for these schemes, that itself is a separate line of practice where not many people are there in this particular line. Reason, many of them don't know DGFT provisions. Many of them doesn't even have exposure to foreign trade policy. They don't know how the documentation works. Once you know the art of, the science of this concept, you can play around with this particular area. So post-qualification, you can think of this area as a value add for your career. Moving further. Next is your DFIA scheme, Duty-Free Import Authorization Scheme. Page number 9.31. Page number 9.31. Let me see if there are any doubts so far. So far, so good. Let me continue back. DFIA, Duty-Free Import Authorization, which is a post facility, which is a post-export facility. Duty-free import authorization means I get a authorization. This is for causing a imports. How? Without payment of duty. I repeat, it is an authorization. It is an authorization for making imports without payment of duty, which is called duty-free or DFIA. As the name goes, this is the authorization which is given my post-export facility. In case of advance authorization, what was happening? I import under a license, I manufacture and export. Now, in this case, I do the processing, then I go for getting this DFIA. Take it from students. This is one concept. Majority of us don't even know that there is a scheme called DFIA which could have been enjoyed. Now, this particular scheme, DFIA, is only for those goods where there is a SION notified. Now, in case of advance authorization, even without SION, I can make a self-declaration, go to the norms committee, get that SION fixed. Now, in case of DFIA, only for those goods where there is a SION, I can come for DFIA. Right? Now, so here what happens, who is interested to get to this scheme called DFIA, what I will do? First, I'll declare myself, saying that, sir, look, I'm a manufacturer. I have so-and-so process, and this is my SION. I go to the particular RA consent, and I make a application. I make a application with DGFT authorities for generating a file number. Now, I file an application with the authority saying that, look, I do this process and this is my SION and I want to go for DFIA. I go for DFIA. So once I declare to the authority, that RA will give something called file number. Now, this file number is important for me. So what I will do, once I get the file number, then I do the process. I export the goods within a period of 12 months from the date of getting the file number. So I process, I manufacture my goods, and then I export the goods within a span of 12 months from the day I got my file number allocated. Now, this particular file number, whatever has been allotted to me, I mention all my export documentation. Why? I have to prove the officer concerned because it's a post-export facility. My invoice, my commercial invoice, parking list, bill of lading, shipping bill, or export bill of export. All these documents will have a reference called file number. Why it is to be given? Because to prove to the RA that I have exported the goods as per the declaration given to you and the CON which was given to you. Now, whatever export I have said I am going to do, I have met the export obligation. How do I do? Post completion. Mere export is not sufficient. I have to repatriate money where there is a foreign currency required. So wherever money is required to be repatriated in foreign currency, I do that. Then I go back to the concerned RA. Why? Said, look, I came to you 12 months back. I took this particular authorization for DFIA. I made an export. Okay, what you've done? So these are the shipping bills where I have done so much of export obligation. And this is my FAIC or EBRC number. So for all these exports, look, this is the money released in foreign currency. My banker has given a certificate for these particular transactions. I come back to this particular RA and explain all this to issue something called transferable DFIA. As the name goes, this DFIA is an authorization. I can use it for myself. I can transfer to someone else. So friends, students, I would bring to your attention that any manufacturer who happens to be a regular exporter, who doesn't look at this option, this benefit, please think about it. I export the goods on the basis of the export value. I get a certificate called DFIA. So this consent RA shall verify all the details were given. He will look into CON, he will look into the export obligation, he will look into the documents which are given. Based on all these compliances, he issues something called transferable DFIA. And this has got a validity life of 12 months. So from the day that authorization has come, within a span of 12 months, I have to encash that particular thing. So this consent applicant, what he will do, he will register this DFIA with the customs authorities. Now, what do you mean by registration? It is just a formality. Like, I go to the customs authorities and say, so my IEC number is so-and-so. For me, this regional authority has given this value of DFIA. So the customs authorities are going to validate. They check this DFIA back with this what you call DGFT authorities, and then give so much of value to this IEC or that particular license. So each license will be loaded with a value which is available on customs portal. And this particular application, this particular license, applicant can use for import or can transfer the license. So what he can do, this particular applicant, for any imports which are going to cause, he can use that particular license without payment of customs duty, or he can sell that particular license to some other party. I'll give an example here. Say, Priya happens to be a regular exporter. Priya has got this particular exports which is being done on the basis of imports. She imported some material, she has processed, and then she has exported. Or she has indigenously procured some goods, she has put into a manufacturing activity, and then she has exported. Now, Priya will go to the RA and say, sir, this is the exports I have done. Based on this, please give me DFIA. So she gets a DFIA. What she will do? She can use it for herself. For a moment, she gets a license for 5 lakhs. This license of 5 lakhs, she can use it for imports, assuming Priya doesn't have any imports. So what she can do, Priya can sell that to Namita. Now, Namita will ask, why should I buy it from you? I can very well pay this 5 lakhs as a customs duty to the authority concerned. Now, assuming for a moment, Nisha happens to be the CFO. She says, look, I have to pay cash of 5 lakhs. Let's do this way. You sell that particular script to me at a cost of 4,50,000. That is 90% of the script value. Now for Priya, she has to make good of money. So the script which has got 5 lakh face value, she can sell for 4.5 lakh, where she gets that money from, say, Namita. Namita will go to the customs authorities. She will show it to the customs authorities, get the clearance of the goods, where the duty will be relaxed for a value of 5 lakhs. So in this entire transaction, what happened? The benefits which were given to Priya were encashed by Namita. Priya in turn got 4.5 lakh as cash into her bank account. So this is the advantage of my DFIA. I can use the license for myself, or I can transfer the license to someone who is interested to use that particular license. So I would recommend, go back and look at the scheme. Go back and look at the scheme, which is of a very important aspect to many who doesn't even look at this scheme, who are actually exporters. Now, there is something called SION, where a reference is brought to actual user condition. That means the product which is manufactured, this SION is only for those users who are into this particular product, generic and actual user. So in case of the process, the SION says, based on the actual user condition, I have said this, then DFIA license is not given. Reason, the activity done by Priya is not an activity every person can do. Only Priya can do this particular activity. So what government says? For those products where SION prescribes that this has to match the actual user condition, I don't give DFIA license. And the DFIA person, whoever has got a license, they have option to procure this material or imports. Again, I can import or I can use it from local, from domestic, indigenous. How do I do that? Invalidation letter. So I go to the concerned DFIA authority, say that, sir, you have given for imports, please validate to my indigenous procurement. This can be done. This license I can use only for payment of BCD. Unlike AAA, advance authorization I can use for BCD, CVD, ADD, safeguard duty. But in case of DFIA, it is only permitted for payment of my basic customs duty. So if I import goods from Singapore, I have to pay, say, basic customs duty, IGST, compensation cess. Now, can I use my DFIA? Answer is only to payment of BCD I can use. For the payment of my IGST or compensation cess, I cannot use this particular license. Now, why they have designed that way? This is a policy decision. They don't want to give the benefit of DFIA like advance authorization. Now, in case of advance authorization, we have discussed that 15% is required. In case of your DFIA, minimum 20% is what they are expecting. Formula, the same way. What we have discussed, A minus B by 100. A is your FOB value, B is your CAF value. So on the basis of this particular nomenclature, now assuming Priya happens to be a manufacturer, she has to prove to the satisfaction of RA that she has met 20% value addition. So if this value addition is not there, I cannot get my DFIA. Assuming for a minute, this particular export, now generally exports have 15 to 20% markup. All those businessmen, where they have 20% or more, please do recommend to get into DFIA scheme. Reason? Very easy. You have to check first SION to see whether this product has got a notified SION. And if it is there and value addition is 20%, then again, the turnaround time, is it, if it is less than 12 months, get into this process. One license, you may struggle. Once you get the clearance for one license, it is a cakewalk for the all repetitive licenses. Now, based on your SION, quantity of input which is allowed for DFIA, in same proportion, I'll get the value for this license. So what they say, how much value I've imported, proportionate value I'll give you as a benefit under DFIA. So if you imported goods for 10,000 pieces, whose value is say 2 rupees per unit, say 20 lakhs, equivalent 20 lakhs I'll get in my DFIA. Next, duty remission scheme. As I've said, this duty remission scheme, it is a policy matter. My DGFT foreign trade policy does not give any duty drawback. This has prescribed a policy called remission. This has prescribed a policy called remission. How does that remission happens? By way of a customs duty, the drawback, where customs duty paid on inputs, which is given back to the exporter on the basis of my section 74, section 75. Section 74, where the goods as is exported out of India. Section 75, where it is used in the manufacturing process and later I get it back. So under section 75 of Customs Act, this DPK is given on the material where I pay customs duty or central excise, which is used in the manufacturing or processing of export products. This duty drawback excludes IGST, excludes compensation cess. Under duty remission, they don't give a benefit free hand to IGST or compensation cess. Yeah. Next, this is a new scheme which has come from 1st Jan 2021. With effect from Jan 2021, government has brought this particular scheme. There was one question in the last attempt. So again, now mutually exclusive, once it is tested in the consecutive attempt, may not be tested so easily. The name goes remission of duties and taxes. Remission of duties and taxes, which are paid on export products. Any duty, any tax which is paid on the products which are exported, they wanted to give it back by way of a remission. How does this happen? This is a scheme which is globally accepted principle. The goods can be exported, services can be exported, but not the local taxes per se. Keeping that in mind, this principle of remission of duty, tax on export products was launched. So what they say, for those products what we are talking, there should be a payment of taxes, there should be a payment of duties. Taxes covered, collected by central government, taxes collected by state government, taxes collected by local authority. Like example, see, Madurai Panchayat, Madurai municipality, the local laws have got their own regulation. What they say, any goods which are consumed in this particular Madurai municipal limits, they should pay a tax of 2%. The taxes could have been paid to the state government, could have been paid to the local authority, could have been paid to the central government. The duty, that is the customs duty, could have been paid to the central government. And those goods, if are exported, and if it is exported, the government should generally exempt that particular duty, or it should be given back. It should be given back to the exporter. Now, this is a principle which is internationally accepted. Now, what they say, look, someone is coming to India for the purpose of setting up their business. And this particular company, they do operations in India. They also export out of India. When the goods are exported out of India, you give a exemption for the taxes and duties paid in India, or you give back that money to that exporter. What if there is no exemption, if the money is not given back to that fellow, then this particular amount which was suffered on these export goods are given back as a remission. How it happens? There will be a amount in the form of duty credit script, like your electronic credit ledger under GST law. There's a ledger, there is a exporter's ledger, which is maintained with customs authority. Like I have electronic cash ledger, electronic credit ledger. My electronic credit ledger will be credited with a value called duty credit script. So this is a basic process. This is a basic aspect which is concerned with my RODTEP. Now, we are at 8 o'clock. Let's have a break for 5 minutes and then let us resume back with our discussion. let us continue with our discussion on this aspect called RODTEP. Now, this particular scheme, when it has been launched in Jan 2021, government has very clear mandate. Now, this is one of the, I would say, pressure or a kind of motive or a move for implementing this concept in India because of the global trade practice. When GST has come into picture, where there is an open up of your input tax credit. Prior to that, central excise, VAT, CST, like cascading effect of VAT on excise duty, cascading effect of CST on excise duty. And there were various reasons where this RODTEP was very, very important of nature. But after GST has come, its importance is being diluted. Unfortunately, after the GST has come, this law was brought into India. Again, as per the WTO practice, this was implemented. So they say that, look, I'm going to reimburse you, I'm going to remit back of duty tax levy, which is by central government, state government, or a local level, and which is burned, which is imposed in the exported products. In those cases, this indirect levy has to be compensated. How? It should be either refunded. If not refunded, I'll give back something called a remission as a duty credit script. So the main salient features of this scheme is to provide a refund where the exemption is not there or it was not refunded back. Please keep in mind, if the duty or tax levied has to be exempted or it should be refunded back. Example, IGST. So when I procured the goods, I can procure without payment of IGST. If I have procured, I can make the payment, I can claim a refund. So when you're getting a refund of that IGST paid under Rule 96A, you don't come to RODTEP. So what if customs clearance, I have a shipping bill, I have to make a checkbox. There is an option called RODTEP claim. I have put a tick mark. What is the consignment? Consignment is export with payment of IGST. So when I have paid the tax called GST, I have exported with payment under Rule 96. I shown that it is export with payment of tax, and I got that money from the government. And also I have claimed from the DGFT. Then they say, look, this is a ineligible entitlement. Even though you get that money, subsequent point in time, they recover back from you. Now, what is a duty credit? My duty credit is issued on the basis of notified goods. Where there is a value, it will be on the basis of FOB value or 1.5 times the market value, whichever is lower. They calculate a percentage as the duty credit script available, subject to a capping. So this money, when they have to calculate, they will calculate either on the FOB value. Why FOB? Exports, or 1.5 times the market value, whichever is less. And that money, whatever is calculated, it will be credited back to my electronic credit ledger. And this money I can use for payment of basic customs duty. And can I transfer? Yes, I can transfer. Whatever script I got, I can use it for myself, or I can do a transfer to some other interested importer. What they say, look, I'm giving on a basis of condition that you are going to repatriate the money. If the money is not being repatriated, then I'll presume that this duty credit script was never given to you. I'll take it back from you. Usually, this is calculated as a percentage of 2% to 6% is a bandwidth we have, which is calculated on the FOB value. Now, in the process of calculating, they say, look, these supplies I don't consider for RODTEP. What is that? Goods imported into India and exported in the same form or substantially same form. You have imported a cord, you have exported back the cord. Now, where is the question of local taxes? They say local duty or taxes suffered, I am going to pay you back. Now, any import which happened in the same form and the export is also happening in the same form, where there is no valuation, they're not going to give because there is no manufacturing activity which is happening. Goods are transshipped from a third party nation, came into India and transshipped through India. I cannot call that as a exports. If there are goods where there is a minimum export price declared or there is applicability of export duty. When I look into my Schedule 2, of Customs Tariff Act, there are few goods for which there is a minimum export price. Like example, export of sugar, they say it should be per kg 150 rupees. Sugar sold in India 80 rupees. When you export, they have declared that 150 rupees. So wherever the goods are subjected to export duty or export price, those will not be entitled for this scheme. And the goods which are prohibited for export or which are restricted, I cannot claim an application. Goods which are manufactured by DTA unit to SEZ, supply of goods manufactured by a DTA and which are supplied to SEZ or FTWZ. Now, SEZ or FTWZ, they don't pay any duties or taxes. And similarly, this DTA is entitled for a refund of those taxes. Accordingly, this supplier cannot claim a benefit under this scheme. Similarly, goods manufactured in a electronic hardware technology park or biotechnology park. Now, these particular industry, they cannot enjoy the benefit. I'll skip this also. Now, let's come to the core topic of discussion called EPCG, Export Promotion Capital Goods Scheme. I'll give you a backdrop of this scheme and then as on today what it stands, I'll explain you. EPCG is a scheme which has been notified where under excise era, the goods which are procured are subjected to customs duty, are subjected to excise duty. Not forgetting your VAT and sales tax. So what they have done, this EPCG should be made as a scheme where we promote industries to flourish. We promote industries to come up with the MSME sector, non-MSME sector. I'll give an example. Say there is a job work activity called wire cutting or sheet bending, metal sheet bending. I don't know how many of you have seen this ancillary job work units. There are MSME, like a small foundry. In the foundry, they do the wire cutting. They also do the sheet cutting or sheet bending. Generally, this process is given to a third party as a job work rather than doing in-house. For the simple reason, one is your capital requirement. Second is the proficiency required. For a wire cutting, I need to have 25 lakhs as a machinery. And this particular machinery cannot be absorbed over a period of 10 to 15 years given the internal requirement of wire cutting. Similarly, sheet bending. For whatever be the process, I have a sheet metal which needs to be cut, which needs to be bent, which needs to be molded. There should be a embossing of a print. This activity, if I do in-house, the kind of investment I do is enormous because each particular machinery is worth somewhere 20 lakhs to 25 lakhs, which is a brand new. And if it is a second hand, 16 to 18 lakhs is the value of that particular machinery. So the government has got this advisory team who have made a research and said this capital goods incentive should be provided by way of an exemption of excise duty, by way of an exemption of the customs duty. So what they have done, this local manufacturer who has been doing this particular activity, he doesn't either register under excise because of the ceiling of 1.5 crore, or even if he is registered, he doesn't have this bandwidth of getting the compliances. So to get a level playing field, they brought this scheme called Export Promotion Capital Goods Scheme, where they give an incentive of capital goods to be purchased without payment of customs duty. All those ancillary units who are less than 1.5 crore, but who can definitely do a value addition either for export or given to a manufacturer who can export. Considering this particular industry, they are well thought and say, let's give this capital goods scheme. And what is the time limit for compliance? They felt that, look, 2 years, 3 years, nothing is going to happen. Let's have minimum of 5 years. So they have come with a particular time limit with a value which they have to re-export, with which this scheme was introduced. So central excise, that was a golden era where this scheme was of full-fledged utilization, even by a small-time businessman. So this EPCG is focusing on that particular industry where there is a potential for export, potential for having a level playing field in terms of international trade. To start with, EPCG, I can use this particular scheme in case of export, where I can import my capital goods. I import capital goods for pre-production, during production, or post-production. Example, I need to set up a particular pre-production activity called, like example, your ATM boxes. I get a metal sheet of 10 by 10 size. So pre-production, I just cut the sheets into 5 by 5, 2 by 2, 4 by 4, whatever is the design. Pre-production, I just do an activity before the main production starts. That's called pre-production. In the process of production, I use this machinery as one of the ingredient of main production. Post-production, called packing activity. Say, I have manufactured a tool. Post-manufacture, my company name should be embossed with there is something called imprinting using your UV rays. So there is a program, there is a machine where there is a UV rays put onto a steel rod to put a name. Now, putting a name, again, that is a separate process, which could be done a post-production process. So I can have this capital goods where they permit pre-production, during the production, post-production. All these 3 stages, they have said, look, you can get the benefit of EPCG. How? For procuring this machinery at 0 customs duty, or procure indigenously without paying the duty in the prescribed manner, without paying duty or taxes concerned. Now here, right now we talk about GST. Prior to GST, we had this concept of central excise. So the government said, look, you want to buy within India, don't pay the taxes in India. You want to import from a foreign nation, you import without payment of customs duty. Under GST law, section 147, deemed exports, read with a notification notified. Any goods supplied under EPCG license holder, I can charge GST, claim a refund from the department. And the buyer who is buying those goods need not pay the GST to the manufacturer or to the supplier. So the starting point is earlier to GST, central excise, after GST, the GST consent, or in case of imports, don't pay any customs duty. Now, what they say, look, I give you this incentive. In turn, I give you an obligation. What is that? Export obligation. You use that machinery in turn to make exports. And what I give you as an authorization, this has got a validity for 18 months to cause imports. So you decide, I have given you EPCG license. You can use this license within a span of 18 months. You decide. You want to buy within India, you want to import from Spain, you want to import from Russia, you want to import from Australia. Choice is up to you. So I give you a license which is valid for 18 months. So why 18 months is given? When I have to set up my process, when I have to set up my factory, generally it takes at least 12 months to 18 months to set line by line various machinery. And my machinery, I have to pool my funds, I have to ensure my vendor is there to supply the machinery. So that's the reason they have given a span of 18 months. And this particular EPCG, capital goods procured under EPCG, under GST law till 30th September, this exemption from GST was brought into picture. Hoping that new foreign trade policy is going to come, like 21-26 has to come into picture. Because of COVID, there was little dilly-dally in terms of the exemption provisions. Now, they say, I give this export, the scheme as an actual user condition. That means to say, if this particular license has been applied by, say, Nisha. Now, this export obligation cannot be shifted from Nisha to Priya, from Nisha to Namita. Whatever license was applied by an applicant, that applicant has to export to cause this particular export obligation. Now, in addition to this, when I say actual user, Nisha may make a direct export, or Nisha may supply to Namita. Namita in turn is going to make an actual export. This also can be called as your export obligation under various rules. Moving further. Now, when I say actual user condition, government says very clear, look, I have given a norm card, norm export obligation. Till this export obligation has not been met, you cannot sell or you cannot transfer. If you recollect, students, fixed assets schedule. When you prepare your fixed assets schedule under your Companies Act or various provisions concerned, if there is a export obligation, your guidance note on the government duty or this particular scheme's concern. There was a guidance note issued by ICAI where they say the value of obligation, the export obligation casted on this particular thing, the duty which was saved should have been not disclosed, quantified, saying that this particular machinery was caused under this EPCG scheme, where the export obligation is left for remaining period of 3 years, remaining period of 4 years. So what happens generally, the statutory auditors, they take a certificate of confirmation from the assessee saying that, please confirm, was there is a contingent liability in terms of any government schemes notified in this regard. So I, as a EPCG license holder, I have to give a quantification saying that, sir, I saved a duty of 20 lakhs by way of EPCG. And this 20 lakhs, assuming 5 times or 6 times, this is the value of exports I have to do. So out of 20 lakhs, I have satisfied, say, 15 lakhs. Balance 5 lakhs is the export obligation, which I have to meet with. So I have to give a disclosure called contingency liability, read with your duty remission or the duty which was enjoyed by way of these particular licenses. And those assets, I give a note saying that these are the list of assets where there was a reference to EPCG or advance authorization kind of licenses. Why? To create a contingent liability for the value of obligation not met with. Moving further, the government says that, look, you have to release money in foreign currency, but for deemed exports. What is your deemed exports? I manufacture the goods. So like Nisha has imported the machinery. Nisha can sell this particular goods to, say, Namita. Namita holds advance authorization. So for a moment, Nisha is registered in the state of West Bengal. From West Bengal, she sells the goods to Namita, who happens to be in, say, Haryana. Namita, in turn from Haryana, she exports the goods out of India. So Nisha sells to Namita, Namita exports out of India. Namita holds advance authorization. So based on advance authorization, Nisha gets the benefit of this export obligation where money need not come in foreign currency. Also, supplies to SEZ shall also be taken into account for calculation of your EO. The condition is money to be received in foreign currency from a SEZ unit. So what if it is a SEZ developer? I can get money in my INR. Whatever we have discussed about DFIA, same process is applicable for EPCG. So assuming for a moment Nisha has applied for EPCG license, she can manufacture these goods. She can sell to Namita, who holds advance authorization. She can sell to, say, Naveen, who is a SEZ unit. She can sell to Priya, who happens to be a SEZ developer. All these cases, in addition, Nisha can make a direct exports. All this will be considered for my export obligation. One condition, in case if it is a deemed exports, INR. In case it is a SEZ, foreign currency. In case if it is your deemed exports, INR. Now, so is this allowed only for manufacturer? This is also available for a merchant exporter. Manufacturer, yes, allowed. Merchant exporter who is connected with the supporting manufacturer. That means to say, Nisha does the manufacturing activity. It is given to, say, Pramod. Pramod actually exports out of India. Then Pramod is called merchant exporter. Nisha is called supporting manufacturer. Now, in case, say, Pramod has got a well connect with UAE. All the region of UAE, he has got a potential leads in UAE where Pramod is not a manufacturer. So what he can do, Pramod can buy from Nisha. When Pramod is exporting out of India, the shipping bill, which is to be filed by Pramod, he discloses that, so these goods are manufactured by Nisha, who is my supporting manufacturer. So the details of Nisha should forthcome on my shipping bill. So the government says, generally, I encourage manufacturing exporter. What if this manufacturing exporter doesn't have a direct nexus to export? Then let me route it through a merchant exporter. Who is a merchant exporter? Who doesn't do manufacturing, who just exports out of India. So this merchant exporter needs to disclose that so-and-so person is a merchant manufacturer, supporting manufacturer. Their details should come in the shipping bill. So IEC of Nisha along with IEC of Pramod is sufficient for claiming or export discharge for Nisha. Even for service providers. Service provider can also declare, who are declared as a common service provider, can get into EPCG's benefit. Now, so what are the capital goods I can import? I can import in CKD condition, SKD condition. I can import a computer system. I can import a software, which also form part of capital goods. So when I see computer system and computer software, most of the students may get a question. Sir, we are chartered accountants. Can we import capital goods? That is, say, Dell, HP or Lenovo laptop without payment of customs duty under EPCG scheme? I would say yes, provided you have a client abroad, you make an export of services to that particular client. If you are notified, there is a service provider. If advocates, chartered accountants, or architect, designer, these are called common service providers. These common service providers can also get into the benefit called EPCG. Space, molds, dies, jigs, fixtures, catalyst, and capital goods for project imports notified by CBIC. These are the set of goods which I can import under EPCG scheme. Now, examination, this will be tested for 4 marks. As a holder of EPCG license, what is the export obligation to be met with? As a holder of EPCG license, I have to meet with specific export obligation, average export obligation. They say you have an export obligation. This export obligation, the government, the foreign trade policy identified into 2 buckets. Bucket 1, specific obligation. Bucket 2, average obligation. What is specific obligation? Specific obligation where they say, look, Nisha, you have imported this machinery. So you being an exporter, you have to export goods. How? 6 times the duty saved. You have saved the export duty. So you export the goods worth 6 times the duty saved. If Nisha says, sir, I've saved 1 lakh, 6 times 1 lakh, 6 lakhs. So you export the goods 6 times the amount of duty what you have saved. So what is the time limit? Within 6 years from the date of getting the license. I repeat, the government says that you quantify the amount of duty saved. This duty what you have saved, 6 times of that export within a span of 6 years. 6 times 6 years. You can easily remember in your examination. This is called specific obligation. Now, how do they specify? Look, this export obligation within a block of 1 to 4 years, please attain 50%, minimum 50%. They don't say 39, 40, etc. Within a span of first 4 years, year 1, year 2, year 3, year 4, minimum 50% of this export obligation. Let's take an example. Sir, 6 lakhs is the worth of material I have exported. 1 lakh is the value of duty I have said. On 1 lakh, 6 lakhs you are saying. So year 1, year 2, year 3, year 4, at least make exports of 3 lakhs. That is what they say. In the second block, that is 5th and 6th year, you meet the remaining export obligation. That is the balance 3 lakhs. Look at the way the policymaker has designed. If you look at this concept of first block, second block, how they want to ensure this. They don't want to sleep and be active only in 1 year. They want you to be active in a phased manner. Look, I given an opportunity, slowly develop yourself. I'll give you 4 years to get back the value of 50%. Once you have given enough time, 50th and 6th year, become hyperactive and meet the remaining export obligation. So what if I have not met with this 50% in the year, a block of 1 to 4? Then they say you pay some compensation fee for failure to comply with the time limit. Because they have given time limit, in some reasons you're not able to achieve this particular export obligation. Then there is a compensation fee where you pay nominal fee on the basis of duty saved, and you get a time extended for this particular export obligation. So what happens? What is this average export? Now, the government, the policymaker is very cautious. Look, I will study your business process. Last 3 years, what you have done? Last 3 years, say, out of your total receipts, 20% was from exports. I repeat. Last 3 years, your average exports is 20%. So what they say? For the same and similar products, what was your average? Please maintain that average. How? During the EO period. Last 3 years, you had 20% of revenue from exports. So you have list of goods which are being exported. You ensure that within the block of that 6 periods, the same average is maintained. That means when a new machinery has come, I should see an increase in your export revenue. They say that last 3 years, you have this particular exports met. You continue that export turnover in the export obligation period. So what if I brought this machinery till last year, I was doing export for this particular set of machinery. Once a new machinery has come, the old machinery was discarded. Now, assuming that out of the old machinery exports were happening, because of discarding old machinery, this export was not met. They will take away that particular value, and the balance value you have to maintain. So, well thought of provision with respect to your export obligation and also your specific obligation. Now, they say that I have given a 6 times requirement in case of imports. In case of domestic, I'll give you only 75%. Like Nisha's case, 1 lakh was a duty saved. if Nisha purchases same machinery from India, not imported, so they say that instead of 6 times 1 lakh, now I'll give you only 75% of 1 lakh on that 6 times. So effective 75% of 6 happen to be 4.5 times. So they say that whatever duty you have saved, 4.5 times of that duty, where if the goods, this capital goods are purchased within India. Examination at best, these are the 2 aspects which would be tested. Deemed exports, the shipments under advance authorization, DFIA, duty drawback, all this will be counted for your EPCG benefit. Now, so if I have met with my export obligation much ahead, then they will give me something called discharge certificate for paying this money well in advance. So there is an aspect called condonation. Sir, I have met 75% of the export obligation much within the obligation average period. Then there is a mechanism where consent RA can condone, which generally doesn't happen, students. Now, there's a continuation to EPCG, something else called post-export EPCG script. Now, this is again a duty transferable script where this is a mechanism where, sir, I don't know that there is a EPCG benefit. I have purchased a machinery. I have imported a machinery with payment of duty. Now, this particular scheme says that where goods are imported on full payment of duty, you make an application to the consent RA where you do the export obligation, whatever was met, on the basis of the customs duty, what you have paid. I will give you 85% of the applicable export obligation as a duty script. And this duty script can be used as a reward scheme. Next, the next topic in your syllabus, EOU, EHTP, STP, and BTP scheme. Let me come to the respective material, page number. This particular scheme, students, I've just touched the basics which are relevant from examination point of view. The concepts which are self-explanatory, I have ignored for paucity of time. Look at your institute material, page number 9.43. Page number 9.43. Now, EOU, electronic hardware technology park, software technology park, biotechnology park. Now, these are the various schemes over a period, like mushroom industry. These schemes have been evolved over a period of time. So, based on the industry which flourishes, based on the money from which industry, foreign exchange inflow is happening, outflow is happening. Based on the industry where employment opportunities are being created, the government has well thought of and come with this kind of schemes. EOU is a generic manufacturing industry, export hardware technology park, concerned predominantly with hardware connected with software technology park. Most of the software companies, they register themselves with STPI for the reason they can import their capital goods without payment of customs duty. Like example, sir, I have a parent company in US, I have a parent company in Singapore, I have a parent company in Australia. What I do, I have a back office entity in India. I do some sort of development called programming or development of software or doing some data processing, data mining, etc. for the parent company. I can call myself as a software technology partner. I enroll myself with STPI for the purpose of import of capital goods without payment of customs duty. At the same time, I can procure the services also without payment of taxes. Under GST, there is no specific exemption unlike EOU or EPCG for STP. BTP, Biotechnology Park. Though this particular BTP was brought in, not much momentum was seen, but for the customs related provisions concerned. So this is a scheme which is governed under the aegis of Ministry of Commerce and Industry. And STP is a scheme which is governed by Ministry of Information Technology. Biotechnology, which is again governed by the Department of Biotechnology. So each of these industry have got different industries, different bodies which they do administration. However, the policy framing was given as a free hand to foreign trade policy. So what happens? This Information Technology Ministry or Biotechnology Ministry, they come to the Ministry of Commerce and say, look, this particular trademen, they wanted some incentives for import of capital goods, for import of inputs, for the purpose of development of this biotechnology. So based on the recommendations from the respective ministry, these various branches have evolved over a period of time. What is the basic criteria to get into this particular scheme? These units may be set up for manufacturing of respective goods, or they may undertake small activity, ancillary activity, in addition to manufacture called repair, remaking, reconditioning, or re-engineering, or rendering of services, development of software. The key element which is set aside is trading units are not covered. Trading units are not covered under this particular scheme. Trading units are not covered under this particular scheme. Now, the government says that, look, I want to give you a separate setup called EOU or EHTP. You do a manufacturing, you do a development, you do a research, you do a repair, you do a re-engineering. These units should be meant for the objective which was laid out. If you want to do a training activity, it is not permissible. Reason? To create employment opportunities, to create this particular industry to flourish, I set up the various schemes. So as of now, trading is not permissible. 1 mark MCQ. XYZ Private Limited, they are into import and export of laptops. They wanted to register themselves as a EHTP, being dealt with electronic hardware technology products. Whether they are permissible to register themselves as EHTP. Now, import and export as a trader, not permissible. False. Next. Those projects where minimum investment of 1 crore in plant and machinery is required, they say, you please get into these schemes. Now, initially, government, when they have come with the schemes, see, when you see as a policy decision, whenever the ministry comes with so-and-so notification, initially, they wanted to give a try with the bigger establishments. So only those establishments who have bandwidth of investment of 1 crore, they are permitted. Later, with the special recommendation, they can, even smaller ancillary units, there's something called DA, decision authorities. This decision-making authorities have permitted even a small ancillary handicraft units to get into this STP or EHTP. Initially, they have proposed 1 crore is the requirement investment. Later, they say nothing doing. You can just get into with a small investment, provided there's a development authority who gives a approval for that. The main purpose of this entity is net foreign exchange. They say, look, you get into this particular separate entity where you have a positive NFE in a blockage of 5 years. So what they do? I permit you to export, I permit you to do domestic transaction. However, when you see your net foreign exchange, the value of total exports compared with domestic clearances, your net, there is an equation given which was not tested in your syllabus. So we will skip this net foreign exchange positivity. So they say when I do a calculation of this net foreign exchange, it should be positive in a given block of 5 years. There's something connected with this particular block of supply. So they have given list of supplies which can also be regarded as your supplies for NFE. So they say, look, you can make exports, you can make supplies to DTA who's having a domestic tariff unit who have advance authorization, advance, I think it's a repetition, annual requirement, DFIA, EPCG. So this is that any domestic unit who holds these licenses, you sell to this DTA, even that will be considered as your export obligation. Supplies affected to DTA where money comes in a foreign currency. Supplies to EOU, FTP or other units, again considered. Supplies to a bonded warehouse where manufacturing activity happens and from there export happens, again considered as a scheme for NFE. Next, there's a small answering topic called deemed exports in your foreign trade policy, chapter number 7. Examination, not much can be expected from deemed exports. However, there's one particular table. I just wanted to draw your attention to that particular page of institute material. This discussion, what we are going to have on deemed exports, connected with page number 9.52. Categories of supplies which are considered as deemed exports. Let me explain the backdrop, students, then we will come to this particular page. Categories of supplies which are considered as deemed exports. Prior to that, what is a deemed export? This deemed export has got an importance under chapter 7 of foreign trade policy, where they say there are transactions where goods supplied do not leave country. Section 147 of GST law, which also has defined as a deemed exports. It is deeming fiction that it is an export, but actually the goods does not leave India. And also, payment for those supplies are received in INR instead of foreign exchange. So they say that those supplies which are regarded as foreign trade, which are specified in foreign trade policy, reference to this particular page number 9.52. Page number 9.52 has defined some supplies as a deemed exports under your chapter 7. What are those? Supplies to a DTA who is holding this advance authorization. Supplies to international competitive bidding. What is this international competitive bidding? Sir, I have this 5G license auction. Now, when 5G license auction is happening, there are few license bidding which happened from China. 2020-21, Ministry of our Indian government have completely said no for those bidding which have come from China for 5G auction. Similarly, if there is any auction for nuclear plant setup, if there is an auction for some software technology related plant setup, I can participate in that particular international competitive bidding. Those can be considered as your deemed exports. Supplies for infrastructure projects of national importance. Like example, there is a place called Kudangulam in Kerala. Kudangulam happens to be a border of Kerala and Tamil Nadu, where the government of India has set up something called nuclear power project. Nuclear power project is one of the national importance. So any supplies which are done to this nuclear power project in Kudangulam, which is in Kerala, all those supplies will be considered as your deemed exports. What is the importance? I can supply without any duties or taxes. So come to your page number 9.52, where they have given supply of a manufacturer supplied by main or subcontractor. So these are the three set of classifications what they have said to be a deemed exports. Supply of goods against advance authorization for annual or DFIA. So any supplies to this holder, they have said it is a DFIA. Supply of goods to units located in EOU, STP, BTP, EHTP. So if I supply any of my manufactured goods to another EOU, another STP, even that is called as deemed exports. Supply of capital goods against EPCG authorization, again called as your deemed exports. If you look at the other table, supply of goods to mega power projects against international competitive bidding, even if customs duty on imports made by such project is not zero. So this international competitive bidding is where there is a international trade connected with. Point number 2 in the same page, the other table, supply of goods to United Nations or international organizations like World Bank, World Health Organization, UNICEF, etc. Supply of goods to nuclear projects through competitive bidding. All these are considered as my deemed exports. So why do I do deemed exports? What benefits I can think for making a deemed exports? So in case of deemed exports, these are subjected to, they are eligible for benefits. What is that? Duty need not pay, or money repatriation convertible foreign currency need not be done. So they say that you supply to advance authorization or other entities, or where there is a refund of terminal excise duty. Now, terminal excise duty is levied under Schedule 4 on tobacco products, petroleum products. So this deemed exports connected with Schedule 4 petroleum products, like Indian Oil Corporation, British Petroleum. If I'm a manufacturer, I supply goods to this particular, the goods which are under Schedule 4 of central excise, which is levied as of today, I get a drawback called terminal excise duty. Manufacture of granite, manufacture of this petroleum products, which in turn are sold to this oil refinery agencies like BP, HP, I get a refund called terminal excise duty. Now, this is one particular area not many of us have an exposure into. So with this, we come to the end of our today's discussion on a topic called foreign trade policy. Examination students, what I would recommend, most of your points are connected with MCQ, advanced authorization, EPCG. This is what you can expect from your examination. Let me see questions for today. There's one question from Namita. No, a couple of questions from Namita. She's asking, so these capital goods are allowed to be purchased duty-free for job work or to manufacture. Job work or manufacture, both are permissible, Priya. As a job worker, I sell to manufacturer, use in a process and then export. I'll be called as a supporting manufacturer. So even I get a benefit as a job worker. Capital goods can be purchased without payment of GST. How is it possible? As word duty is written, duty or taxes, Namita. If you refer to your IGST Act, read with your CGST Act, under section 147, there is a deemed exports, advance authorization, your DFIA or EPCG. These three are considered as deemed exports where seller can charge GST, claim a refund of that particular tax. So it is very much permissible under Rule 18.9, Namita. Next question. Namita is asking a continuation question of this capital goods. If Nisha gives to Namita, Namita in turn, like say Nisha is a job worker, Namita happens to be a manufacturer. So Nisha is a supporting manufacturer to Namita. Namita is exporting back. Then Nisha gets this export obligation complaints on the basis of Namita, who is in turn exporting out of India. Continuation. There's one question from Namita. So if EPC is given for 5 years, no, it is generally for 6 years, ma'am. Customs duty saved is 25 lakhs, but in 5 years, Mr. A is able to settle only 20 lakhs. So the balance 5 lakhs, Namita, if I am not able to meet with the balance 5 lakhs, the differential duty, whatever is there, along with interest and penalty, the FTP authorities will claim it back. Namita is asking this question. Average export obligation is not clear. See, average export obligation, Namita, without this EPCG scheme, what exports you are doing? Now, if EPCG comes, I am saying that you should meet this 6 times the duty saved as an export obligation. So whatever exports you are doing currently, please continue to show that. In addition to this average, let that new revenue come as an export. I'll come to Excel file to make you clear. Let me come to my Excel file. Say year 1, year 2, year 3. Domestic exports. So domestic is 85 lakhs, 98 lakhs, 112 lakhs. This is in lakhs. And export is say 12 lakhs, 15 lakhs, and 15 lakhs. Now, my total revenue, year wise, if I see, Namita. Now, what is your average exports in the last 3 years? So I'll say average of $112 lakhs is my average, Namita, right? Now, year 4, I'm adding a machinery under EPCG scheme, right? So what the government says, assuming duty saved is 10 lakhs. So my export obligation will be 60 lakhs. So the government says that, look, in a spread of 6 years, that is year 5, year 6, year 7, year 8, year 9, year 10. When I look into this export obligation period, Namita, your average should be maintained 112 lakhs. So this export turnover should be there as it is, and new export obligation, because 6 years, 60 lakhs, 10 lakhs, 10 lakhs, 10 lakhs. I'm just giving a simple equation, Namita. 60 lakhs is what I have to meet within the span of 6 years. So they say that your total exports should be year 5, year 6. So assuming that this is my average, you maintain minimum 112 lakhs. If your average is 115, I'm okay with that. But prove that this 112 lakhs retains as it is. In addition to that, you bring the additional export turnover on account of your EPCG. So this is the export obligation which they are asking for average, Namita. Hope this is clear, ma? Yes, Naveen, this is the last and final session for your paper 8. And yes, Vidya, this is the last session. Namita is asking, sir, in section 13, place of supply, we did not cover deemed exports. So deemed exports for place of supply provisions, the goods are within India. In section 13, one of the supply service provider or supplier or recipient happens to be outside India. My deemed exports doesn't travel out of India. Place of supply has been brought in an aspect called export or import. Now, in case of export, the place of supply should happen outside India. Then only the benefit of taxation will be given, right? So this is the last question which has come for the day. Students, we have, this is the last session for me. Before I wind up, I'll give you a couple of few tips for your examination point of view. See, exams are just to test your conceptual knowledge to get into the industry. So don't take exams as the only mantra to say if you pass, you're good. If you don't pass, you're not good. I don't say that way. Put in your efforts. Put in your efforts to clear your exam. To clear your exams, you should have a strategy. Out of say 4 papers in group 1, 4 papers in group 2, you have say 1 or 2 papers which are very interesting topics where you are damn sure 60 to 70 you can score easily. Those papers where you can score say 70 bare minimum, please target to get 80 to 95. Sorry, 85 to 90. Reason, when you focus 85 to 90, one, you get an exemption. Second, you get an average for other papers. So look at your group 1, look at your group 2. This is your initial point. Second point, look at your institute material. I would recommend all of you, please focus your institute material thoroughly. Reason, my institute material is the aspect which is going to cover upon my examination questions. Your examination questions are MCQs precisely from institute material and also from RTP. Third mantra. You have your recent amendments, income tax, indirect tax. Board of Studies comes with the detailed analysis called these are the amendments which are applicable for May 22 or say November 22. That particular write-up, from there, at least 2 questions will be tested for your examination. Income tax, indirect tax. So prepare for that particular thing. Now, when you have to have 40 marks, your MCQ, you prepare so well that at least 20 marks can be fetched from there. You have recent amendments where at least 6 to 8 marks can be fetched from there. So out of 40, you have 28 marks. Rest is what is required, 12 marks. There are few chapters like a refund under GST law, your input tax credit. Till date, there is no question paper set in your examination without input tax credit calculation, without output tax calculation, and a refund related matter valuation. Now, there are 3-4 chapters where the examination has a question paper pattern out of these 4 topics concerned. Prepare well from those particular chapters: registration, returns, refund, payment of taxes, input tax credit. Now, out of 4 modules, if you look at 4 modules, you may feel it is very vast. Don't look at that way. Look at these 4-5 chapters. Those 4-5 chapters thoroughly practice from your institute material for the reason the questions are based from the problems which are tested from your institute material. May not be the same figures, but the pattern is going to be the same. This is how you need to focus from your examination point of view. Now, all said and done, examinations I have cleared. What is next I have to do? You have a bright career, you have a bright future having a qualified chartered accountant once you come out of the curriculum. Look at these 4 pillars: costing, taxation, law, financial accounting. These 4 pillars are connecting dots which are going to help you to make a great career. And one more qualification called, say, your data analytics. And one another profession in addition to this to make up a sound-proof profession for your career. You get into industry, add this particular SAP or data science. If you want to get into practice, you focus on these 4 pillars. So what else I can do? If you're in the age gap of 22 to 24 or 25, I would recommend please get into civil services. Reason, you have a very good career along with this professional degree with civil services, right? So with this, I thank Board of Studies ICAI for giving this opportunity. I also thank all the students for your active participation and patience listening. I enjoyed thoroughly all along teaching your paper 8 GST related matters and customs foreign trade policy. With this, I end my discussion for today. Come with bright colors. All the best for your examinations. Good night, goodbye, and Jai Hind.